All right, let's talk about something that's a huge part of your job benefits, but let's be honest, can be super confusing, your workplace pension. We're going to break it all down and decode it together. So let's just jump right to the single most important question you need to ask about your plan. Is it a promise or is it a partnership? In other words, is your employer guaranteeing you a certain amount of money when you retire, or are you guys in it together, sharing the risks and hopefully the rewards? Getting this one difference is the key to, well, everything else. If you've ever stared at your pension statement and just kind of scratched your head, you are definitely not alone. These things are incredibly powerful tools for your future, but man, they are often wrapped up in so much jargon. So our goal here is to just slice right through all that confusion and give you some real clarity. So why are we even talking about this? Why does it matter so much? Because a group plan isn't just some dusty old savings account. Nope. It's an engine for your retirement with some amazing and often hidden advantages. Let's pull back the curtain. Okay, check out these built-in superpowers. First up, employer contributions. Seriously, think of this as free money. It's like getting a raise that goes directly to your future self. Second, the saving is automatic. It just happens, right from your paycheck, so you don't even have to think about it. Then you've got other awesome perks, like creditor protection, meaning if you ever hit a rough patch financially, this money is generally safe. And way down the road, income splitting could seriously lower your family's tax bill in retirement. These are huge wins you just can't get on your own. To really get your plan, you need to understand the big idea behind it. Pretty much every plan out there falls into one of two buckets, which we're going to call the promise versus the partnership. This right here nails the difference. Over on the left, you've got the promise. Your employer takes care of everything. They guarantee you a paycheck for life, no matter what the stock market does. They are carrying all the investment risk. Now, on the right, you have the partnership. This is a team effort. You and your employer contribute, and your final payout depends on how well those investments do. In this case, you take on the risk, but you also get the chance for much higher growth. So let's put the official name on the promise. It's called a defined benefit plan, or DBP, and there's a reason people call it the gold standard. It's all about certainty. You know exactly what you're going to get, which takes a whole lot of guesswork out of planning for retirement. So this brings up a really important question, right? If these plans are so fantastic for employees, why are they getting harder and harder to find? Well, the answer really boils down to two things: risk and time. This chart tells a wild story. Just look at this. In 1990, one big pension plan in Canada had only 13 members who were over 100 years old. Fast forward to 2020, and that number exploded to 147. Now, people living longer is an amazing thing, but for a company that promised to pay someone a pension for their entire life, that extra longevity creates a massive, unpredictable financial headache. And that huge long-term pressure is exactly why the partnership model has become so popular. Its official name is a Defined Contribution Pension Plan, or DCPP. With this, the company's financial commitment is clear and predictable. They contribute a set amount. From there, the ball is in your court. You're in the driver's seat, making the investment choices that will ultimately shape your retirement. Okay, so while the promise and partnership plans are the two big ones, they're not the only game in town. Your employer might offer a few other ways to save. So let's do a quick tour of the other common plans you might see. You've probably heard of a personal RRSP, right? Well, a group RRSP, or GRSP, is basically just the workplace version of that. It works under the exact same rules. Both you and your employer can put money in, it all goes towards your personal RRSP contribution limit, and you often get the benefit of lower investment fees than you could get by yourself. Let's make this super clear with an example. Meet Reginald. He makes $60,000 a year, which gives him $10,800 in total RRSP room. Now, through his group plan at work, both he and his employer contribute a total of $6,000. So here's the key part. That leaves him with $4,800 of contribution room that he can still use in his own personal RRSP. The group plan uses up part of your limit. It doesn't create a new one. Two other plans you might run into are a DPSP and a group TFSA. A deferred profit sharing plan is pretty cool. Only your employer contributes, and they do it by sharing a piece of the company's profits. So when the business does well, you do well. Then there's the group TFSA, which works just like a personal one. You don't get a tax deduction now, but every single dollar it grows by and every dollar you pull out later is 100% tax-free.
All right, so you've spent your entire career saving up in one of these plans. That's awesome. But now for the big question. How do you actually turn that big pile of savings into a regular paycheck when you retire? This is what we call the payout phase.
This is a really important step. When it's time to retire, the type of account you saved in dictates the rules for taking money out. If your money's in a pension plan like a DCPP, those funds are considered locked in because they're meant to provide an income for life. You'll move them into something called a life income fund, or LIF, which has both a minimum and a maximum you can take out each year. But if your money's in something like a GRSP, it's not locked in. You'll move it to a retirement income fund, or RRIF. It has a minimum you have to take out, but no maximum, so a lot more flexibility. Okay, we have covered a ton of ground here, from promises to partnerships, from saving to spending. So what should you actually do with all this new info? Let's boil it all down to a simple 3-step action plan. So here's your game plan. First, figure out what you've got. Is it a promise or a partnership? Just knowing that is your starting point. Second, and this is a big one, maximize the employer match. If your company offers to match what you put in, that is the best return on investment you will ever find. It is literally free money. Make sure you are getting every last cent. And finally, remember that your workplace plan, as great as it is just one piece of the puzzle. It's designed to work with your personal savings, not replace them entirely. Let's just end on this one thought. You work hard for your money, every single day. The big question is your retirement plan working just as hard for you? Now you've got the tools to find out and to take control. Thanks for tuning in.